Ever thought about playing the stock market with someone else's money? It's a goosebumps proposition, isn't it? But before you dive headfirst into this financial deep end, let's take a moment to explore the potential rewards and the inherent risks of trading in the share market with borrowed money. First, let's talk about the potential rewards. For those who have mastered the art of investing, trading with borrowed money can amplify their gains. If you buy a stock at $10 with your own money and it rises to $15, you've made a 50% profit. However, if you had borrowed money to buy more of that stock, your profits could be significantly higher. But here's the catch. The potential rewards come with equally significant risks. The same leverage that can amplify your gains can also magnify your losses. That stock that rose to $15 could just as easily have fallen to $5. If you'd invested your own money, you'd be out $5 per share. But if you'd borrowed money to buy more shares, your losses would be much greater. The risks don't stop there. When you borrow money to invest, you're not just risking the money you've invested. You're also putting at risk the money you've borrowed. If your investments don't pan out, you're still on the hook for the money you owe. And if you can't pay it back, you could end up in financial ruin. There's also the risk of margin calls. If the value of your investments falls below a certain level, your broker can demand that you deposit more money or securities into your account to cover the shortfall. If you can't meet the margin call, your broker can sell your investments to cover the debt, potentially at a loss. Now let's take a look at the real world. Remember the story of Nick Leeson, the rogue trader who brought down Barings Bank, one of Britain's oldest banks, by trading with borrowed money. Leeson racked up losses of more than $1 billion, which ultimately led to the bank's collapse. And it's not just individuals who can get burned. During the financial crisis of 2008, many financial institutions had borrowed heavily to invest in mortgage-backed securities. When the housing market collapsed, these institutions found themselves unable to repay their debts, leading to a global financial meltdown. So, where does this leave us? Trading in the share market with borrowed money can be a high-risk, high-reward proposition. It can potentially amplify your gains, but it can also magnify your losses. And it's not just your own money that's at risk. You're also putting at risk the money you've borrowed. If your investments don't pan out, you could end up in financial ruin. In conclusion, trading in the share market with borrowed money is not for the faint of heart. It requires a deep understanding of the market, a well-thought-out investment strategy, and a high tolerance for risk. And even then, there are no guarantees. So before you dive in, make sure you're well prepared to navigate the potential rewards and the inherent risks.